Welcome to Scenario, the deep dive podcast for in-depth analysis and reviews. Today, we're diving deep into a crisis that really reshaped the global economy. The 2007-2008 financial crisis, often called the Great Recession, will be drawing heavily on insights from F. Stogati, specifically from a lecture available on YouTube. Our goal here is to kind of unpack the origins, the dynamics, and the implications of this really complex crisis, making it accessible and hopefully illuminating for you. We'll explore how this crisis, which seemed to start in the interbank market, had such deep and lasting effects, marking a sort of dividing line between an era of widespread economic growth and a period of, well, potential stagnation.
It's pretty remarkable, isn't it, how something can ignite in one specific corner, the interbank market in this case, and then just ripple outwards with such huge, persistent consequences for the entire world economy. And as our source, Zagati, points out, what made the 2007 crisis kind of unique was its origin. It wasn't like the stock market crashes or, crises managed mainly by governments. This was different.
Okay, right. Let's try and get a handle on that. Stogati reminds us that, well, up until 2007, the world was pretty much used to growth, maybe at different speeds, the US, Germany, Italy, but generally things were growing. Then, from 2008 onwards, the whole picture changes dramatically. Demand for consumer goods drops, investment slows right down. Even that tiny 0.2% growth in Italian exports he mentions feels almost like a statistical blip, not real growth.
Exactly. And the key point highlighted is that this generation, our generation maybe, finds itself at a kind of watershed. Previous generations lived through generally widespread growth. Now, though, we're potentially facing this prolonged stagnation. It's a fundamental shift in how you think about and, frankly, manage the economy.
Yeah, and this is where it gets really interesting, I think. The source talks about this non-Eurocentric map of the world, a strong signal, right, of how global balances have shifted. And then there's the idea that state borders seem blurrier, and the ever-increasing role of English as the sort of default language in the global economy. And then we get to the term itself, Great Recession, and just the sheer scale of it. You look at Japan's GDP drop, minus 5.3%, Italy minus 5.1% in 2009 alone. Oof.
What's fascinating there is bringing in the concept of secular stagnation, which Larry Summers revived. The term goes way back to the 30s. We're not just talking about a standard recession, a sharp dip and then recovery. This is potentially a long phase where global GDP growth averages near zero. And in that kind of environment, focusing on tiny little quarter-to-quarter GDP variations, well, it almost misses the point, doesn't it? It distracts from needing to tackle the big structural problems head on.
Mm-hmm. And the signs of this shift are, well, they're all around us if you look. That dramatic rise in postgraduate immigration from Italy, the New York Times article, Embracing the Other Italy, that's a pretty clear symptom of a lack of growth, right?
Yeah.
Stogati really hammers home this need to actually recognize and confront these issues. It's a warning, like, don't just wait for things to magically fix themselves.
And that raises a big question for you listening. How did previous generations who were used to a growing economy, usually with rising prices, find themselves so unprepared for a stagnant economy, maybe even one with falling prices? Deflation. We've potentially shifted from an economy where inflation was almost baked in to one where deflation is a real possibility. And that has huge consequences for how businesses have to operate. The goal of our chat today, as the source clarifies, isn't to give you some super technical breakdown, but more a framework for thinking about this idea of secular stagnation. It's an approach that maybe goes against the grain based on logic and data.
So, okay, practically speaking, what does this all mean? The measure of the crisis, the source tells us, is that loss in GDP per capita. Between 2007 and 2013, Italy was one of the hardest hit, down 8.5%. And if the stagnation continues, well, the impact on per capita income over time could be severe. It's really anomalous if you compare it to, say, the kind of per capita GDP growth Italy saw back in the 70s.
Right, and it's crucial to see that even in countries that did, relatively speaking, better, like the U.S., per capita GDP growth was still pretty modest, like plus 6% over 6 years. That tells you the stagnation thing is broad, it directly impacts people's well-being, which, despite debates about other measures, income is still a major component of. And let's not forget the devastating social impact, 3.5 million jobs lost just like that because of the crisis.
Yeah. And looking ahead, those IMF forecasts from January 2015, they showed really low or stagnant growth rates for Europe compared to the U.S. It kind of backed up that idea that Europe wasn't really the economic center of the world anymore. But then you looked at emerging economies.
Yeah.
Mexico, Brazil, India, China.
Much higher growth rates predicted.
That growth gap is a huge indicator of a rapidly changing world. And the critique of, being too Eurocentric, maybe overvaluing things like made in Italy without objectively comparing them to what's happening elsewhere.
Yeah.
That's vital. The call to think like global citizens, to seize opportunities worldwide, becomes really essential for you. Even China's growth slowing down, while maybe natural after decades of explosive expansion, still signals a shift in global dynamics.
Okay. But how did we get here? What was the trigger point? When did it all start to unravel? The source points to a specific date, August 9th, 2007. That's when BNP Paribas announced it was freezing redemptions on 3 investment funds. Stogatti calls it an atomic bomb for the financial system. And what's interesting there is that apparently many banks already knew BNP Paribas was in trouble before the public announcement. That event basically marks the start of the credit crisis or credit crunch. It's a freezing up of the interbank market, that place where banks lend liquidity to each other super quickly, mostly based on mutual trust. To understand why that credit crisis happened, you really have to understand how that interbank market works.
Right. And to do that, the source takes us back to the distinction between commercial banks and investment banks before the year 2000, a separation put in place by the U.S. Banking Act of 1933. Commercial banks, the ones dealing with families and regular businesses, were seen as sort of safe places for deposits. Crucially, they weren't supposed to just invest those deposits directly or lend them out willy-nilly.
Yeah, the mechanism involved depositing funds with the central bank, and then this concept of leverage, basically, every dollar deposited allowed them to lend out many times that amount. Maybe 40 times, the source suggests. Credit, often provided through overdrafts and checks, high-powered money, essentially was the real engine of the economy. Investment banks, on the other hand, couldn't take deposits and couldn't borrow directly from the central bank. They funded themselves mainly by issuing bonds, kind of separate worlds.
Okay, so the interbank market was where these different banks loan money back and forth, mostly over the phone, quick informal deals based on trust. The interest rate on these loans, the interbank rate, was closely tied to the central bank's discount rate, with the central bank acting as the lender of last resort if needed. But what happened when one bank, like BNP Paribas, suddenly wasn't trusted anymore by the others?
Well, then the cost of borrowing for that bank skyrockets. Other banks just refuse to lend to them, and that leads to this credit freeze we talked about. Banks just stopped lending to each other because the trust evaporated. And the reason for that lack of trust, it came down to the widespread belief or fear that many banks were holding these toxic assets on their books, specifically asset-backed securities or ABS.
Okay. Toxic assets.
Yeah.
So how does an asset become toxic? The source walks us through the U.S. subprime mortgage market. You had the traditional way of doing mortgages, careful risk assessment. The bank holds the loan itself. That got replaced by this new model, originate and distribute the risk.
Right. Mortgages got sliced up. You had prime loans for low-risk borrowers and subprime for those with shakier credit histories. Then, through a process called securitization, thousands of these mortgages, the underlying assets were bundled together to create a new financial product, the ABS. This derivative promised high returns based on the stream of payments from all those mortgages. And these ABS things spread like wildfire through the interbank market because, hey, they offered much better yields than safe government bonds at the time.
But the core assumption that the underlying mortgages were a solid guarantee turned out to be, well, fundamentally flawed, especially the subprime ones. As the source notes, citing the book title When the Music Stopped, people kind of knew these ABS things were risky.
You had this chain reaction. Low interest rates on government bonds meant traders struggled to make profits, so they hunted for higher yields. They found them in ABS. The crisis hits when demand for these ABS suddenly collapses. Their price heads towards zero and nobody wants them. And that freezes the interbank market because banks looked at each other and thought, I have no idea how much of this worthless stuff you have on your books, so no more lending. The source even mentions direct experience of this ABS bond market seizing up in February 2008.
Wow. So it's a shift from, a mortgage isn't for everyone, we need to check carefully, to basically a mortgage for everyone, sometimes even zero down, with extra cash for furniture thrown in.
Exactly. The main goal wasn't necessarily ensuring the borrower could repay consistently over 30 years. It was often just about packaging and selling that derivative, that ABS, as quickly as possible. And this helps us understand the real nature of the crisis. The dominant narrative you sometimes hear that it was a public debt crisis caused by citizens living beyond their means. Stogatti argues that's just wrong. The crisis originated squarely in the banking sector, not in the real economy initially. Supply chains were working, growth was happening before the crisis hit.
Right. It was the credit crunch. The freeze in lending between banks that then spread rapidly to businesses needing credit to operate, that was the actual engine driving the recession. The source emphasizes how crucial credit is for the whole economy to function, and even looks at M2 money supply data in the US versus Europe to show how different monetary policy responses affected the recovery later on.
And, banks are profit-driven businesses. To get credit flowing again, businesses need to present solid, viable projects. It's not just about turning the taps back on indiscriminately.
So what caused this credit crunch at such a fundamental level? The source identifies 4 key factors that kind of coincided over about 15 years.
Okay, factor 1. China's huge success with its trade balance. They consistently exported more than they imported. This meant massive amounts of capital, mostly US dollars earned from exports, flowed into China. The Chinese central bank accumulated enormous dollar reserves. And what did they do with all those dollars starting in the 90s? They bought huge amounts of US government debt treasury bonds.
Ah, okay. So China buying all those U.S. bonds increased demand, which pushed up the price of the bonds and, crucially, pushed down their yield, the interest rate they paid.
Exactly. And those lower yields on safe U.S. government bonds put pressure back on those traders we mentioned, pushing them to look for higher returns elsewhere, like in those risky ABS.
Okay, that's factor 1. What's number 2?
Factor 2. The dot-com crash back in 2000. Remember that bubble in tech stocks?
Oh, yeah, big time.
When that bubble burst, the U.S. Federal Reserve reacted by aggressively cutting interest rates, the federal funds rate.
Why cut rates during a stock market crash?
Well, a lot of stock buying, especially during the bubble, was done on margin using borrowed money. When prices crash, you get margin calls, forcing people to sell assets to cover their loans, which pushes prices down further. Cutting rates made borrowing cheaper, easing the pressure from margin calls and slowing down the forced selling, but it also hammered the yields on those safe government bonds again.
Making it even harder for traders to make money the traditional way, pushing them towards risk again. Got it. Factor 3.
Factor 3. September 11th, 2001, the attacks on the Twin Towers.
Right.
That caused immediate panic in financial markets. The Fed actually shut the markets temporarily, and then they injected massive amounts of liquidity cash into the system to stabilize things and cut interest rates even further.
So again, same effect. Lower rates on safe assets, more pressure on traders to find yield, making riskier assets look more appealing.
Precisely. Persistent difficulty making returns on safe stuff kept pushing people towards the risky stuff like ABS.
And the 4th factor, you mentioned it was hinted at.
Yeah, factor 4, which the source touches on, is the regulatory change. The end of that separation between commercial and investment banking in the U.S. in 1999.
That was the repeal of the Glass-Steagall Act, part of the 1933 Banking Act, right, under Clinton.
Correct. That allowed banks to operate in both areas, taking deposits and doing riskier investment banking activities. It blurred the lines and arguably changed the culture, ending an era represented by figures like Paul Volcker, who later argued for bringing back that separation.
So these 4 factors kind of converged over 15 years.
Right. China's reserves pushing down yields, the dot-com response pushing down yields, 9/11 pushing down yields, and regulatory changes allowing banks to mix traditional banking with riskier activities. It all created the conditions for the crisis to ignite when those ABS assets finally imploded. So, as we've seen, the 2007 crisis was incredibly complex. It had roots in global economic shifts, financial innovation, and regulatory changes, all culminating in that freeze-up of the interbank market. The causes, as we've explored following Stodogotti's analysis, are tangled and interconnected, a far cry from the simplistic narrative about sovereign debt being the original sin.
Hopefully, this deep dive into the origins and the mechanics of the Great Recession has given you a clearer, more nuanced perspective on an event that really continues to shape our economic present. Thanks for listening. Follow our upcoming deep dives and check out past ones by subscribing. All the best to you, and until next time.